employee ownership trusts have become quite popular over the past sort of 10 years. As of November 2015, the capital gains tax relief that was in place before has been halved. So previously, a sale of a business to a qualifying business to an EOT would get 100% relief. So the tax on that would be 0 or 0% essentially. Now the relief is only set at 50%. So if the tax rate was 20%, in theory you'd half it and you pay tax at 10%. Based on how the legislation is written at the moment, disposal of your own business to an employee ownership trust, you can't claim business asset disposal relief, which you normally would be claiming if you're making a trade sale, as long as you've not claimed it before. So in this instance, the 50% relief from the top line would essentially apply to the higher rate of capital gains, which currently is 24%, which is why we've quoted an effective rate of CGT for 12% on transactions. Obviously, that will change depending on your annual exemption that you've got for CGT, if you've got any losses, etc. But generally speaking, that's probably a good yardstick to use for shareholders that are looking to potentially use an EOT. There's a potential, obviously, that over time the 50% relief might change as well, and the higher rate of capital gains tax may change as well. But at the moment, those are the best figures that we have. And it's still better than a trade sale, essentially, when both of the figures are identical. Because at the moment, business asset disposal relief is 14%, and that's going up to 18% after April 26. So both of them are slightly higher than the 12, but obviously it's not as beneficial as it was prior to November, where that tax disappeared essentially. With an employee ownership trust, we normally recommend that it's not considered purely for tax reasons, because not all businesses will suit an EOT, and it's got to be the right business that goes into an EOT. So do it for that reason, not for the tax reasons. But obviously, the revenue are probably thinking that more people have used it than they were hoping or expecting. So it's quite disappointing. But yeah, that was the biggest bomb I think they dropped in the budget.
Yeah, and the fact that it started
immediately
2 days ago, so no one had time to prepare, because obviously there was a big changes to capital gains tax last year. Everyone knew it was coming, so everyone pushed through transactions to get them done in time to benefit from the existing rates. Like I say, that just wasn't the case this year. It wasn't really spoken about. I know Martin was at a conference, so I assume that was for centred around EOTs, because they are so common and popular at the minute. And it does feel like all the things we talk about to owner managed businesses are like of good options have been
clawed back.
Been clawed back. The going after cars, going after EOTs, going after salary sacrifice pension. It's sort of like, look, we're trying to do best by our clients and show them how they can win, in which is becoming a
very hard environment.
Which is just attacking small businesses. It feels a little bit like, unfortunately. But I suppose when they set the stall out that they're not going to go after individuals, unfortunately, it means the business
community gets
the most impacted. Anything else on that one?
Probably the only thing I'd say on these is, if you are looking at doing an EOT, then it would probably be a good time to consider it and review it, and potentially look at the timing of it. So we've got a few clients who were looking at EOTs, but it's very much been, I'll do one in 3 years. Well, that's okay, but if by that time the relief has been wiped out completely, or it's at 75% or 25%, then obviously it's going to get worse. So on some of the discussions we've had, it might accelerate the window that they exit via an EOT, if in that instance it is the best option, because they don't want the risk of either the higher rate tax limit going up, so their 50% relief goes up as well, or that other changes may come into force, maybe a cap or some other metric. So if you're thinking of your exit options, even if you don't know them at the moment, it's a good time to revisit them and consider them. Even if you are thinking that it's going to be 5 years, actually there may be logic to bringing it forward to 3, depending on how the numbers stack up.